Hello guys, how you doing? I hope you're doing very well. Let's jump into this lecture and get done with it. So, like I said, we're getting to the end of the lecture, the mentorship in its totality. So today we'll just take on some topics that I find relevant and important to you, and that I think you should understand about. So first, let's talk about prop firms and funded accounts. So, what's a prop firm? This is the short for a proprietary firm, and this is a company that provides traders with access to large trading capitals. So what this is that instead of trading your own money, you trade the firm's money, and in return you share a portion of the profit. So think of Profirm as an institutional investor that is funding professional and profitable traders. So essentially, Profirm invests in skilled traders, allowing them to scale faster without needing huge personal accounts. So how this works in the modern day system of prop firms. So how this works is, one, you have an evaluation or a challenge phase. So what it is that you are given a demo account with specific trading objective, such as reach a profit target of 8 to 10%, avoid hitting a maximum loss of maybe 5% daily or 10% total or 8% total. And you need to trade for a minimum number of days. Usually it's like 3 days, 5 days. So, and then after that, you get to the verification stage, which is also called a phase two or a second phase evaluation. So, after passing the first phase, you must repeat your performance under similar rules just to prove your consistency. Then you have the third phase, which is the funded account phase. Once verified, you receive a live account funded by the firm, and in this phase, you generally share profits with the firm. You the model today is about 80 to 20 or 90 to 10. So profit you make is split between you and the firm, and it's often around 80 to 20 or 90 to 10 in your favor. So let's talk about what a trading plan is. So a trading plan is a structured plan that defines how and when a trader enters or exits trades based on specific conditions. So it's essentially your game plan, combining analysis, risk management, timing, psychology into a repeatable method designed to produce consistent profits. I am pretty sure I touched on trading structure, trading routine, trading protocol in the previous lecture on psychology. So the trading plan is your game plan. Technically, it's just combining everything together to come up with a mode of operation, how you operate with the market. Again, like I said, this is a business, so you actually need a mode of operation, you need a protocol. So without a plan, trading becomes guessing and eventually even becomes gambling. So why you need a trading plan? One is having a well-defined strategy helps you avoid emotions. It helps you maintain your discipline and consistency. Your consistency is very important. It also helps you evaluate your performance, because now you're tracking something, you're being measured against something, so you can evaluate if you're getting better or not. It helps you identify what works and what doesn't, and it also helps you manage risk more efficiently. So a strategy helps you stay focused on the process rather than the outcome. So a trading plan is comprised of your strategy, your risk, your emotional reaction to the market, and everything. Think of it as a game plan, what you will do in every scenario, and it can your trading plan can get better over time, because you're not expected to know how to do everything in the beginning. So as you trade, as you stay consistent, as you're getting more feedback, you can include this and include that. Oh, I take partials here, I break even here, I take profit here. So it can become better. So it's your trading plan you would effect first before you change anything in your trading. Anything that has not gone into your trading plan will not go into your trading. So you will not see one new random trade someone posted, and because you understand the concept, just trade it. You have to put in your trading plan. Usually after you've back tested it to be sure that it's something you want to do. So the core elements of a trading strategy, number one is the market selection, right? You must know what market you want to trade. You can't start out trading everything. There are institutions today that are trading a wide variety of instruments, but in the beginning, it doesn't matter. You want a core sets of instruments or assets. You want to just prime yourself to the market. You want to understand what this is all about first. It's not very important to trade everything and to try everything. Most people can drive a car, but there are cars that most people still cannot drive. And you don't really lose anything by not being able to drive some of these vehicles. So you'll be able to drive a regular car, and some of you can even ride a motorcycle and a bicycle, and maybe even a scooter. But then you probably cannot move an F1 vehicle. You probably cannot move some specialized race cars. You probably cannot drive efficiently a truck, a trailer. You probably cannot fly a plane. So it's not everything that you will know how to do. However, the higher you go, and that requires more experience, more time, the higher you go in your trading journey and you keep getting feedback, the more things you can do naturally. So now you can decide to trade commodities and stocks and bonds and indices and options. But this requires more study, and it requires peace of mind, because you must have gotten to a point where you are not trying to force the market again, and you have more experience. If you make mistakes, you can fall back on what you know because you believe in that. So you must select your markets. The easiest and most accessible is the forex market. So you tend to see people jump into this at first, but it doesn't mean you will find success there. Just start with whatever is most accessible to you. There is the indices, there is the commodities, there is the all forms of instruments, energies, anyone that is most accessible to you, start. There is no wrong answer to this. So we also have time frame selection. So you need to know the kind of trader you want to be. Remember the lecture on types of traders. There's the scalpers, there's the day traders, there's the position traders, and there is the swing traders. You need to know the kind of trader you want to be. Once you know the kind of trader you want to be, it will inform the time frames that you want to be using now. Albeit even if you are a scalper, you want to still have an idea of the higher time frame. And remember the concept of the top down analysis, looking for it from an higher time frame to understand what is happening on a broad perspective before you scale down to a time frame that really reflects your trading style. So you want to focus on a time frame that is relevant to you. Also set up criteria. You want to decide if you are more technical or you are fundamental. You want to understand what you require to enter a trade and what you require to exit. So everything that just forms your in and out of the market, your setup and everything is very important. So your entry rules. So you must decide what must happen before entering a trade. So these are the theoretical side of what makes up a trading strategy. So you must have an entry rule or multiple entry rules, depending. The simpler the better, and you must know this at the back of your hand. A a common saying is that you must be able to write your trading plan on a business card. It must be that simple, that short, and that simple. And when you write it on a business plan, if you give it to someone, they must be able to understand what you have just written. So keep that in mind as well. So your exit routes is very important. So when to close a profit or a loss. So your exit rule also speaks about your stop loss. How do you exit a trade after a loss? How do you take profit? Again, I tell you, taking profit is one of the most difficult things in the market, and over time it gets more complex because you won't stick to your conventional profit taking at risk to rewards. You start learning to swing trades, you start learning to hold positions longer, you start learning to do some exotic styles of trading, and just gets more complex, but it's exciting. This is how you engage yourself in the market and just get better over time. You must also be very conscious of your risk management, and you must know what lot sizes you're trading and what your stop loss is, what your risk is per trade. You must always know what your risk is, but you must never enter a trade without knowing how much you're losing on that trade. It is an abomination. You must always enter a trade with the knowledge of how much you are about to lose, and you must accept that. You must accept that, oh, I'm about to lose this amount in this trade, and you must know before you get into the trade. You must know it before you get into the trade. Also, you must have a review process. You must know how you journal and how you refine over time. How should I remove this? Should I add this? Because what you track, what you measure, you can manage. So because you are tracking it, you are measuring it, you can see signs. Oh, I take too much losses on Monday, I will stop trading on Monday. You see over a 3 month period, you have 20 trades on Monday and you've only had a winning trade on two. Mondays are very, very unprofitable for you. and then you see, oh, I'm more profitable on Fridays, or I'm more profitable on Thursdays. You now know how to optimize risk. If by all means you still want to trade on Monday, feedback from that is that it it could be relevant to reduce your risk on Monday and add that risk to the Friday trade. And you see, this is how you use data to help your trading. It's very, very important. Everything can be tracked. The health can be tracked, relationships can be tracked, your your emotional reactions can be tracked, your impulses, everything can be tracked. So why not just track trading as well and take data from it? The truth is that numbers actually do not lie. The moment you have these numbers, you know for a fact that this is this and this is what this means. And again, the same way, you shouldn't fool yourself when it comes to your personality, your character, your emotional impulses. Don't fool yourself when it comes to your numbers. If your numbers say this is what you are and this is how you are doing, it is the truth. Work on improving it. Don't lie to yourself and assume that you are better than none. There's no need. There's no need to fool yourself. The quicker you can accept the reality of who you are, the faster you will succeed. So again, the core elements of a trading strategy. So when you want to build your own trading strategy, these are things that must be inside of it: your market selection, your time frame or style of trading, your setup criteria, your entry rules, your exit rules, your risk management rules, and your review process. This is the basic things that must be in your trading plan. There are others, but this is the basic. Let's talk about some common losses that you must avoid. So again, every trader faces setback. It's part of the learning curve. However, most trading failures don't come from the market itself. They come from our reactions to the market. Remember your emotional reactions and impulses. Avoiding common mistakes is about developing awareness, discipline, patience, 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 patience. The foundation of long-term success. So one is trading without a plan. Many traders enter the market without a clear strategy, hoping to figure it out as they go. So imagine playing a football match without a goalpost. Imagine playing a basketball match without a net. Imagine playing imagine playing golf without a hole. This is what trading without a plan is. You don't even really know what you're trying to achieve. You don't have an idea. There's not Where are you headed to? Imagine flying a plane without a course. Imagine sailing a ship without anywhere to go. The direction that a ship has, again, you know that direction is more important than speed. If you are going fast in haphazard direction, you probably will end up nowhere, right? But if you have a direction and you're going slow and steadily, at least you have a course that you're reaching for. So it is ridiculous not to trade without a plan. This approach will lead to emotional decisions and inconsistent results. So how do you even know when you are doing too much? How do you know when you are doing little? How do you know how you are improving? How do you know anything when you don't have a plan? A ship on a course to a certain destination will know that it is not on that destination when it is off that destination. But if there was no direction, you don't even know if we are going to the right place. This is a different story from, say, circumnavigation or exploration, where let's just go. But is that what we want to do with our trading? Let's just go. We're not just going. If you can have a plan, if you can draw something out, oh, in 6 months this can happen, in a year this can happen, why not just, and there are two scenarios. You may not get there and you may exceedingly overshoot your goals and your targets. So a plan gives you structure. It gives you an idea of what you should do consistently, monthly, quarterly, biannually, annually, and it's very important for you to take this seriously. So how to fix this is always define your entry, your exit, your risk level, and your risk price before placing a trade. Again, before you enter that trade, you must know how much you're losing on that trade. Treat trading like a business. Every trade should have a reason and a goal. Remember, every trade should have a reason and a goal. Number two is risking too much. Over leveraging or placing large trades due to greed or impatience is one of the fastest ways to lose money. So, again, I think I've touched on this risk thing over and over and over and over. You don't need to risk too much. Again, it is about surviving so you can trade another day. He who lives today lives to fight another day, I think. So if you live today, you can fight another day. Again, you should save your life when you're climbing the mountain. It's very important, because if you don't make it today, you can go back tomorrow and climb Everest. It's not nothing is impossible. As long as, if you try to climb a mountain and then there's heavy blizzard, snowfall, maybe there's an avalanche or something, and you have to abort mission. Abort, you have to abort the mission. All hope is not lost because you can come back again next winter or next summer. You can try again as long as you keep your life. So it's a man who has life that has hope. A man who is not dead. All defeat is psychological for a man who has not lost his life. That is, you can still achieve anything if you have your life. I know I'm relating this too much with death and life, but that's what it is. The loss of your account is the death of your trading, is the death of your business. And if you can do something to extend the life of your business, albeit even if you are taking losses, even if you are not profitable yet, try to extend the life of your business by taking the losses slowly and gradually. The problem most of us have is not really the risk, it's the capital. If you had a large capital which is accessible, there are investors everywhere, there's pools of capital everywhere. Just refine your skills. If you had a large capital, you don't need to do too much to survive monthly, yearly, and even for an entire career. So please take note. Do not risk too much. Know what you are risking before you go into the market. Rule of thumb is 1%. As a beginner, you can risk 0.5%. Just little to just get started. Number three is letting emotions drive decisions. Again, I know I have talked a lot about the impact of emotions, and I would like you to go and check the lecture on trading psychology again. I really hammered on emotional trading in that one. So fear and greed are the enemies of consistency. A trader who gets emotional becomes reactive instead of strategic. Now, how you fix this is follow your trading plan and not your feelings. Journal your emotions after each trade to identify patterns of impulsivity. So number four is chasing the market. So jumping into trades because you don't want to miss out. So this is called FOMO, the fear of missing out. So you see a market that has gone and you just enter buy. This is fear. It's also a form of fear. So there's a fear of taking a loss. There's a fear of missing out. There's a fear of being wrong. There's so many fears. There's so many dimensions in which fear can manifest. So you must not you must not trade impulsively because that's also impulsive trading. You see a trade is buying, maybe you plan for it to buy, you weren't able to get it at your price, and you just buy it and you just jump in, and you're not even able to manage your risk. So you see where this leads to. You just jump in, you don't even know what you're risking. Like, just leads to a compilation of mistakes, and it just messes up your trading. Again, you're human, you will probably do this once or twice, but catch yourself and remind yourself the next time that I shouldn't do this again. It is wrong. Everyone has made mistakes, everyone does the wrong thing, but the difference is that some of us accept that it is wrong, and we decide to fix it on our next trade going forward. So how you fix this is, one, if you missed a setup, let it go. There is going to be over 1 million setups, maybe thousands of setups in your lifetime. Let it go. There is no reason to rush. More will come. The market will always offer another opportunity. Patience is the real edge. There is nothing you can do in this market without patience. If you cannot wait, I'm sorry, even a scalper learns to wait, because most scalpers have a defined time frame that they trade. So if the scalper says, I'm trading only the New York session, I'm trading the London session, for instance, he's waiting all through Asia, he's waiting all through the New York close session. So there is a defined period where a scalper will wait, and because one is a scalper and trading high frequency doesn't mean they trade all setups. So scalpers still have their patterns, their strategy, and if they don't see it, a professional scalper will wait, right? So you still need to learn to wait. If you can do anything to develop your patience, do anything to develop your patience. If you have a child, if you have family around you, if you have anything that you can just use to, while something is exciting you or something is infuriating you, you are learning to chill, you are learning to wait. This will blend into your trading. But if you can develop your patience, you're halfway done. Like, just being a patient person means that you're halfway done. I promise you that. So number five is ignoring the risk to reward. So many traders focus on how much they can make, not how much they could lose. Again, it is not professional to risk or to take a trade, place a position without knowing how much you risk. In fact, that is the only one you can really control, because I promise you, you might sometimes take lucky trades. You might sometimes take a trade. I want to risk $50. Maybe you plan to make 200, and for some very weird reason you decide, I'll take away my TP, let's see what happens, and then the market just shoots, it turns to 1,000. That can happen, really. Anything can happen, but that will happen once in a while, and all that. So there are scenarios where you may not even be able to predict the extent of your profit, but at every point in time you must know how much you're losing. That one must be in your control. So again, focus on your risk as much as you care about your profit. So how you fix this is one, only take trades with a minimum of 1 to risk reward ratio. And this is also subjective too, because depending on your strategy, depending on your style of trading, you decide. Like I said, some people have a negative risk to reward. Some people are risking 1 to make 0.5, that is risking 100 to make 50. Some have found success in it. So it is also a self-reflective journey. Find what works for you, find mentors, listen to them. And if it doesn't work for you, try another thing. Just don't give up. Just keep trying. Someday you'll figure out what works for you, and when you do, stay patient and stick to it. Something else you can do to fix this is a few strong calculated trades will beat impulsive ones. Just learn to wait. Learn to wait for the best ones. Learn to wait for the best ones. It's like overtaking. When you want to overtake when you're driving, you don't just overtake, you don't just swerve your car. No, no, no. It's always very calculated. You want to overtake at a point where there's a distance between you and the car in front of you, such that you can maneuver to the left side or the right side, and that you can overtake, you can drive faster. You want to overtake where it is clear there is enough space for you to drive faster than that car and go ahead of that car, and then sometimes go back to the lane where you are coming from and be in front of that car, and maybe reduce your speed and drive at the normal speed again. So it's calculated. You don't just no, you calculate these things. It's important for you to learn to calculate your trades, the best ones. When you have your day, at first, I don't expect you to know how to calculate your trades. And even at first, I will advise you to, one, if you're doing this alone, do everything, try everything, but make sure you're collecting data, which is why I told you your journal is going to be your best mentor eventually. It's going to be your best feedback system. So if you're trying it alone, do everything, do anything, do everything, but make sure you're tracking everything that you're doing, and then make sure you're reviewing this. So as you're reviewing this, you're able to see this doesn't work, you cut it off. This works, you improve on it, you implement it more, and then you're changing, you are removing, this is very important. So if you're doing this alone, make sure you're journaling and you're tracking. Now, after you do that, you know what works and you know what doesn't. So this is the first option. If you are doing it alone, try everything. If you are not doing it alone and you're doing it with a mentor, look, as long as you trust that mentor, you trust their results, you trust everything, just follow them. That's the truth. Just follow them. Whatever they say, do. Of course, not follow a mentor blindly, but just follow them. Trust what they say, do what they say. And the moment you are off that mentorship, you have some background now, you have some structure. You can now use what your mentor has taught you to build upon yourself and decide, okay, look, this I don't like, this I like, this doesn't work, this works. And then, because you have some structure, it's easier for you to chisel out some things or add some mold to yourself now and become a better trader. So another mistake is overtrading. So trying to make back losses or trading out of boredom leads to burnout and poor results. Don't trade when there is no setup. Don't overtake when the road is blurry or when you cannot see the road ahead. It's very dangerous. So trading out of boredom I mean, don't do anything out of boredom. Don't do anything out of boredom. Do anything because you want to do it. So this leads to burnout and poor results. So how to fix this is, one, you go for quality over quantity. Fewer higher probability trades are much better. So you need to learn to stick to your setup. If it's not there, it's not there. Just stay flat, sit on your hands, as they will say. Another one is neglecting education. So markets evolve. Strategies that worked last year may not work again today. Successful traders are lifelong learners. Look, you will never stop learning. If you think you've learned everything about technical analysis, your emotions will pop up. If you think you've learned anything about your emotions, you will make mistakes when it comes to your risk, or your platform will change, they will update. There's always something to adjust, and just have the mindset of a learner. Have the mindset of always improving. So always have the mindset of, okay, what's there to improve, what's there to learn. This does not mean you'll change what you're doing, but this means that you must be on the lookout to at least take information, and if it doesn't help you, you discard it. So you must learn to continue studying price action, psychology, and risk management. So review your trades regularly and refine your system. Also, meeting with some other professional traders is helpful. What's happening in the industry, what's the trends, what's something that they are doing that might be helpful. Don't neglect the impact of communicating with people. Some little things that you take for granted, and when someone tells you about the result that those tiny little things are making for them, you will be blown away. So do not neglect the impact of friends and professionals and communities as well. In the beginning, communities are not very advisable, but eventually as you grow, you meet people, you share some ideas and you grow together. It's also very, very important. So another problem that most people face is that they quit too soon. Look, don't quit, don't stop. If don't make it your life as well. Don't decide, if I don't trade, I would not do anything. No, no, no. Do other things, because even after you become successful in trading, the hallmark of your trading is going to be evident through the other things that you are doing. You will do other things. There are full-time traders, but eventually they do other things, because trading itself is a business such that you can't trade all the time. When you find success eventually, you cannot trade all the time. You have to do other things. So again, if you are having burnout, or you are getting tired, go ahead and do other things. Do other things with your life. If you can get a job, if you can start a business, do other things, and put trading as a secondary. Study it slowly, study it casually, and just make sure that you're always working on yourself somehow, and eventually you will see results. So most traders give up too soon after a few losses, right before they start to truly understand the game. And this is because most people just jump in with real capital, with money they cannot afford to lose. And when that happens, there is just unbelief, and this is why we advise to trade demo capital. You trade risk free. Just get your skills in place first. It's like it's like not knowing how to shoot a gun. It's like practicing with a toy gun, and you're going to a war. You want to be sure that you can actually pull a trigger, so it's very important that you get your skill in place first. You know that you can, and then you put in real capital on the line. So focus on improvement and not perfection. Consistency grows over time. So just keep doing something every day, every day, every day, every day, 30 minutes every day, 5 minutes every day. It compounds a lot. So keep doing something every day. So avoiding mistakes again is not about being perfect. It's about being self-aware and adaptable. It's about knowing, oh, I messed up on this one and I need to change. I need to fix it. Everybody makes mistakes. Everybody does things. Some people make mistakes that draw them back months and draw them back years. But just know that, I can get better and I will get better, and just keep going. So every professional should have failed at some point. Some keep failing. That's the truth. They keep making mistakes. There is no need to beat yourself over for it. So what sets them apart is that they have learned, adjusted, and they kept going. Again, you haven't failed because of one bad day. You failed if you stop showing up after it. So keep that in mind. If you stop showing up, you have failed. So I hope this one was insightful, and yeah, I just thought this would be very important for you to know. This one is one that, even after many years of trading, you can always come back to this lecture and just study and just take some knowledge from it. So again, guys, I wish you all the best. I wish you all the very best in your trading, and I hope someday we can share stories and we can talk more about how some of these lectures have helped you. Again, this is just your foundation. There is no technical analysis here. You will still, if you're an absolute beginner, you still have to go find technical analysis, find a mentor, learn. But the point of this lecture is to help you know basically what it's all about and decide if you want to do it. And if you don't, well, whatever endeavor that you decide to choose in life, I wish you all the best. So, guys, I'll bring you to landing here, and hopefully the next lecture is our last lecture, and maybe some parting words. And yes, that will bring us to the end of this mentorship in its totality. So anyways, until the next one, guys, I wish you all peace and good luck.